Many founders ask me when we are about to work with them or when we are having like high-level conversations about the reasons why an M&A deal might not go through. And there are many reasons, but I would share today maybe some of the top 5 reasons that typically we see in the market. The first one is missing valuation expectations. So again, founders and buyers, they look at the business from a different lens. And if there is not like a clear agreement or some gap that can be breached, the conversations will get cold very fast. So that's why having like a good preparation ahead of going to market, understanding what are the market multiples for the industry and the type of company you have is very important ahead of going to market. The second, I would say, is weak financial storytelling. If you have strong numbers, they can get you so far and they can create value so long as the storytelling and the numbers themselves are clear and consistent. If your KPIs do not line up, or if your reports, they look messy, the trust from the investor kind of fades away. So, on the other hand, having clear data, organized reports, and a simple story that supports all those metrics will help build trust and value into the process. The third one I would say is targeting the wrong buyer universe. I mean, your company is one of a kind, but there are many potential buyers that could be the right fit. And the same thing, there are many buyers that probably are not the right fit for your business. So, approaching the right buyer with the right story and showcasing how your company addresses a specific need that the buyer might have will bring value into the process, will engage them, and eventually will bring competition and increase multiples. If you go to the wrong buyer, you can waste months and months of conversations that will lead you nowhere. So yeah, having a focus list with a clear go-to message will help you keep the process with sufficient competitive tension and eventually maximize valuation. Another reason is internal misalignments. Sometimes there is a lack of honest and transparent conversations between the founders themselves, between the founders and the shareholders of the company, and those conversations only come up when there is already like an LOI or an offer in place. And if there is not a clear alignment and the process gets stalled because of internal discussions, you lose momentum. And if you lose momentum, then the traction and the tension is very hard to recover. So aligning and having an honest conversation among all the founders or shareholders in the company well in advance of going to market will ensure that the process goes smoothly down the line. And the last one, I would say one of the main ones, is finding surprises during due diligence. Again, missing contracts, specific clauses that might derail the deal that were not shared with investors beforehand, having like financials that do not conciliate with the numbers you shared, other accounting issues, compliance issues, having, personal assets in the business. I mean, anything that erodes the transparency of your metrics and erodes trust or increases the risk perception from the buyer side might derail the process because it can lead to retrades, like adjustment in the valuations, and in the end it can go downhill from there. So again, having everything well prepared in advance and going to market with a clear data room and making sure that there is no red flag that needs to be addressed, it's very important to go to market successfully.